All right, hello everybody, this is Mike Rixey. I am the lead options instructor for Netpicks, and this is our options trade of the week. We have seen a pretty significant shift in market conditions over the past week and a half. Going back into the months of June and July, we saw an incredible run to the upside, pretty much a straight shot higher to all-time highs. It came on lower volume, it came on lower volatility. Everybody was just programmed to buy every single dip. Everybody was programmed just to focus on the markets heading higher and nothing else. Well, as a result, we got into a level of complacency that was near an extreme. Anytime you get that type of a reading, you know that things will normalize over time. Now, we have started to see that happen over the past week and a half. We have seen some uncertainty creep back into this market for the first time in months. You're looking at a daily chart of the Dow ETF. This is symbol DIA. You can see, going back into early June, we saw a pretty big move to the upside. Just over the past week and a half, we saw a pretty big reversal. We saw a sell-off. We actually got down and tested the 200-period moving average. Wednesday and Thursday of this week, we tried to bounce higher, and now we're back down a couple hundred points here today as we end up in the week. All this to say, we have had uncertainty come back into this market. You can also see it in the VIX. Over the past couple of weeks, the VIX has exploded. We went from around 12 to up over 24. We saw the VIX double in a period of about a week. That's something we have not seen in quite some time. I point all this out because we want to take advantage of this type of condition with our options trade of the week here today. We're going to take a look at selling some credit spreads. Now, we've talked about these types of trades in previous videos, and the reason I love these types of trades, there's a lot that you can do to get the odds stacked in your favor. If you buy a call or a put, or if you buy a debit spread, the problem with those trades, they're exciting. They give you a bigger profit potential, but they only give you one way of making money. You need a big directional move in your favor, and it has to happen quickly. That's the only way you're going to make money on those positions. Well, in this period of uncertainty, where we've got some pretty big swings back and forth, what if I wanted to put on a trade that would actually benefit from stocks, and in this case, the Dow ETF, just kind of bouncing back and forth? They can make big moves, but what if we just kind of stay sideways in here? What if we start to chop? Notice how current price action on this daily chart is right in the middle of this cluster of moving averages. There's a lot of support and resistance levels all around us here. I could very well see a period of consolidation kicking in. And one way to take advantage of this type of condition is to sell an iron condor. And we're going to break that down over the next few minutes. If you're expecting a big move higher or a big move lower, there's going to be better trades out there to take advantage of that outlook. But if you're expecting some uncertainty, if you're expecting some choppiness, that's the dreaded type of an environment if you're just going to buy calls and puts. That's how you start to lose money in that type of market scenario. With an iron condor, it allows us to scratch out some profit, to make some money in a period of uncertainty. Would I use these types of trades exclusively? No. It's just one piece of the puzzle. As you start to grow as an options trader, you want to add in some of these different trade types because that's going to give you the ability to react to whatever the market throws our way. So my takeaway from this chart of the Dow is I want to put on a neutral trade that would allow me to make money if the market continues to stay sideways and choppy. So I'm going to go over to the trade page. If we take a look at the trade page of DIA, you'll notice I have all the different expiration cycles available to me down the left. I'm going to open up the September monthly options, and those are the ones with 42 days left to expiration. I'm not going to use the weeklies here. I do want to go farther out in time with an iron condor. My sweet spot, I typically like to go out about 40 days or so. That's very typical. Gives me enough time to let my opinion and let my outlook for the market play out. So we're going to open up those September options. And we're going to start out by talking briefly about what an iron condor is. I know it's a funny name. I know it can be intimidating initially. It's one of those trades that when I first started trading, it took me probably 6 months or so to really wrap my mind around what an iron condor was, how did it benefit me, and why the heck would I use it. And now, over a dozen years later, it's one of my favorite trades. So it's a very crucial piece to add to the puzzle long term, in my opinion. All it simply is selling an out-of-the-money call spread and an out-of-the-money put spread at the same time. So many of us are programmed initially to pick market direction, to pick a big move higher or lower, and that's how we make money. With an iron condor, what I'm trying to do is create what we call a profit window. To put on a trade where I don't care if the stock moves up, down, or sideways. It can do all three of those during the lifespan of the trade. I don't care. I'm trying to pick what type of range I expect that stock to stay inside of. So what I'm going to do here, I'll load up the strikes and we'll break it down in more detail. So I'm going to come out to the 268 call. I'm going to right click on that call option. I'm going to go to sell and I'm going to select Iron Condor from my drop down menu here. When I do that, it's going to pop up an order down at the bottom. Now, you can see there's 4 different options as part of this trade. Even though there's 4 options here, it's done all as one trade. I either want to place this trade as an Iron Condor or not at all. Okay, so you don't want to come in and try to do this 4 options at a time. You want to do this all as one trade. Now, let's talk about the call side first. I do want to sell the 268 call. By default, it loaded up the 269 call as the option that I'm buying as part of this spread. I'm actually going to stretch that out to 270. Okay, I want there to be a $2 wide difference between those strike prices. If I'm selling the 268 call, you'll notice it's about $6.50 away from the current stock price. Ideally, I would like to go somewhere close to that distance away on the put side. So I'm going to take a look. And actually, we're going to go a little bit farther away because I want to because this market is, showing some signs of selling off again. I want to move my break-even point a little bit further away on the downside. So I'm going to go to the 250 put. So let me go ahead and change that strike. And then I'm going to buy the 248 put at the same time. Okay, so there's a $2 wide difference between the strikes on the put side. So what I'm doing here is I'm selling the 268, 270 call spread, and then I'm selling the 250, 248 put spread at the same time. And this one's trading for around $1. It's kind of bouncing around in here. Let's lock it in at $1.08. If I click on confirm and send, let's break this one down in more detail. I am collecting $1.08 or $108 per spread. That's the most money I can make on the trade, regardless of what happens. That's my maximum profit potential. I'm only risking $92. I'm right around a risk 1 to make 1, actually slightly better than that. Here's why I like this. I know it's not a big profit potential. Number one, I'm not tying up a ton of capital, right? I'm not tying up thousands of dollars here if I don't want to. I can trade it multiple times. I can put it on 10 times and still have less than $1,000 at risk. So it's still a very reasonable trade regardless of your account size. The key here is the break-even points, and I'm going to have 2 break-even points. And you'll see it in the order confirmation box. The first one is at 248.92. And that level is calculated by taking the put strike that I'm selling, the 250 put, and we're going to go ahead and subtract whatever I'm collecting to put the trade on, in this case $1.08. That's where I get 248.92. On the upside, my break-even point is at 269.08. And that number is calculated by taking my short call strike, the 268 strike, and adding on the $1.08 that I'm collecting to put the trade on. That defines my profit window. So I'm going to take those 2 numbers, and we're going to go over to the chart here in just a second, and we'll talk about that and how it relates to what we're looking for in the price of DIA stock. Right, and actually, let's go ahead and do that right now. Let's go back over to the daily chart here on DIA. I'm going to go ahead and get rid of all the indicators here. That way we just have a clean chart of price action. And I'm going to draw some price levels here on the chart. I'm going to put one at 248.92. And go get the price level. And then I'm going to put one at 269.08. And let me go ahead and quickly adjust those. That way we can get the prices dialed in here. Now the 2 horizontal white lines, these are going to represent my profit window. I don't care if DIA stock moves up, down, or sideways. As long as it stays inside of these 2 horizontal white lines, I can make money on the position. So let me go ahead and get those dialed in. So you can see the current price is at 261.44. I've got a pretty decent profit window here, right? I don't care if the stock moves up, down, or sideways. It does not matter to me. As long as we stay inside of those 2 white lines over the next 42 days, I can make money. Now, how does that happen? How do I make money from a stock moving straight sideways? This is strictly a play on time decay adding up and volatility decreasing. Anytime that I sell a spread to open up a trade, the whole goal is for that spread to get as cheap as possible so I can buy it back cheaper than what I sold it for to open up the position. Every day that passes here helps me. Every day that passes that we stay inside of those two horizontal white lines, I can make money from the time decay adding up. If the volatility contracts, we just mentioned the volatility has doubled over the past couple of weeks. The VIX has. If I expect the volatility to contract, because we know it will, the volatility market-wide does not tend to stay high for very long. It tends to stay high for a couple days, maybe a couple weeks at a time. I expect over the next 40 days for volatility to contract during that time. That would also help this position make money. The only move that hurts me, actually there's two different moves that could hurt me. A big move higher above this horizontal white line, or a big move lower below the white horizontal line. Those are the only moves that hurt me. And even if that happens, I don't necessarily have to panic. Because in all likelihood, if we get a big move higher or lower from here, chances are, if I wait a few more days, price action is probably going to come right back into my profit window, right inside of those white lines. So it's a very forgiving trade. It's a trade that you don't have to watch very closely. It's not something you have to come in and watch 2-3 times a day. This is a trade with 42 days left that we set it, we put it on. I'm not going to say we forget it, but we're going to check it once a day. Because for the first 20, 25 days of this trade, the P&L is not going to do much. It's really going to start to pick up as we get towards the tail end of the trade, towards the end of the 42 days. That's why I love these trades, because it gives me a way to diversify. It adds in some different types of strategies for me, and then also it doesn't take a ton of time. My schedule gets very, very busy. I can't sit there and watch the markets from opening to closing bell. This is the type of trade that I can put on, maybe check once a day, and then as we get closer to expiration, we'll look to close it out. And my profit goal, let's go back over to the trade page. If I collect $1.08 here, my profit goal is when I can buy this spread back and keep between 50 and 75% of whatever I collected to put the trade on. So in this case, if I can buy this thing back for between 27 and 54 cents, that's my desired range. And what I'm going to do, putting this trade on, I'm going to create my closing order at 27 cents. Why did I pick that number? Because if I can buy it back at 27 cents, that would give me 75% of my maximum profit potential. And that would be an acceptable goal. If we can hit that level, I'd book the profit, free up the capital, and move on to the next trade. So as I said earlier, would I devote my entire trading account to iron condors? No. But is it an important piece to the puzzle? Yes, it is. If I look at my overall portfolio right now, I've got some long call spreads. I've got some short call spreads. I've got some long puts. I've got some short puts. And I have some iron condors. I'm building in layers of diversification. That way, if the market starts to change here, if we start to see another long-term trend develop, I have the diversification there to help manage that type of an environment. That's going to increase my probability of success. It's going to increase the consistent growth in my equity curve. And that's what I'm looking for as a trader. So if you have any questions on this iron condor, feel free to post a comment here inside of the blog, on the YouTube video, or you can email me directly to mike@netpicks.com. All right, so we'll track this trade over the next few weeks. I'll let you know when we're taking it off. We'll take a look next week at our open positions, walk you through what needs to be done to make some adjustments, potentially take some trades off, and then we'll look at a brand new options trade of the week next week. So enjoy your weekend, everybody, and we'll talk to you next week for our next video.